Hello friends, welcome back to the channel. Today we're diving into one of the most powerful trading books ever written, Mind Over Markets, by James F. Dalton, Eric T. Jones, and Robert B. Dalton. If you've ever felt lost in the markets, staring at charts without a clear plan, then this book is going to change the way you trade forever. Unlike traditional trading books that focus on indicators and price patterns, Mind Over Markets teaches you how to think like a professional trader, understanding market structure, reading price action, and using market profile to predict high-probability moves. This book breaks down how the market actually works, helping you build a solid foundation in market-generated information. From the auction process to different trading timeframes, you'll learn how to recognize smart money movements and position yourself ahead of the crowd. So, if you're ready to stop trading on guesswork and start making calculated, confident decisions, then stay tuned because we're breaking it all down in this summary. But before we start, make sure to like, share, and subscribe to the channel. Hit the bell icon so you never miss an update on powerful trading insights. Now, let's get started. If you've ever felt like the market is a chaotic, unpredictable beast, you're not alone. Most traders look at price charts and technical indicators, hoping to decode the market's next move. But what if there was a way to truly understand the market's internal logic, how prices move, why they move, and what's actually driving the behavior of other traders? That's exactly what market profile is all about. It's not just another indicator or trading tool. It's a revolutionary way to see and interpret market behavior in real time. Overview of market profile. Market profile was developed by J. Peter Steidlmayer at the Chicago Board of Trade. The idea? Markets aren't random. They operate as an auction where buyers and sellers constantly negotiate price based on supply and demand. Think of it like this. Imagine you're at an auction house bidding for an antique watch. The auctioneer starts the bidding at $1,000. If no one bites, the price drops. But if multiple bidders jump in, the price rises until demand slows down. That's exactly how markets work. Now, most traders only see the final price movements on a chart. But market profile gives us a behind-the-scenes look at how price discovery actually happens. It organizes market data into a distribution curve, showing where the most trading activity is happening. This helps us spot fair value, the price level where buyers and sellers agree the market should trade; imbalances, areas where one side, buyers or sellers, is aggressively in control; potential trading opportunities. When price moves away from fair value, it often returns, giving traders a chance to enter high-probability trades. Instead of relying solely on candlesticks, moving averages, or RSI, market profile tells us a deeper story: who is in control, how strong they are, and where price is likely to move next. The role of market-generated information. Here's the game changer. The market itself generates all the data you need to make informed decisions. Forget lagging indicators or complicated algorithms. Market profile relies on real-time market behavior, focusing on three key elements. 1. Price, the auction mechanism that reflects the balance between buyers and sellers. 2. Time. The longer price stays at a level, the more accepted it becomes. If price rejects a level quickly, that tells us something too. 3. Volume. How much trading activity is happening at different price levels, showing where traders are placing their bets. By studying these factors, traders can see market trends before they fully develop. Instead of chasing price action blindly, you can position yourself where the market is likely to move next. This is where trading psychology comes in. Most traders fall into emotional traps: fear, greed, hesitation. But when you use market profile, you're no longer guessing. You're reading the market's own language. This builds confidence, improves decision-making, and helps you stay ahead of the game. Stepping into the world of trading can feel overwhelming. Charts, indicators, price movements, it all seems like a never-ending wave of information. But at its core, the market operates on a simple principle: an auction process. Every price movement is a negotiation between buyers and sellers. And understanding this dynamic is the foundation of professional trading. Laying the foundation. Most new traders focus on predicting price movements, looking at candlestick patterns, or following indicators. But professionals don't try to predict the market. They read what the market is telling them in real time. Market Profile provides a structured way to view price action, showing where buyers and sellers agree on value and where imbalances occur. The goal is to move away from random guesswork and develop a strategic approach based on market-generated information. To trade effectively, a solid foundation is necessary. This starts with understanding the auction process. The auction. Markets move through a continuous auction process, where buyers and sellers compete to establish price. Every tick up or down reflects this ongoing negotiation. Imagine a local fish market. Vendors shout their prices, and buyers either accept or walk away. If demand is strong, prices rise. If there's no interest, prices drop. The financial markets work the same way. Traders bid and offer until a fair price is found. This auction process creates trading opportunities. When price moves too far in one direction and buyers disappear, it often reverses. If a level attracts consistent trading activity, it becomes an important reference point. And the imbalances in buying or selling pressure lead to sharp price moves. Market Profile visually organizes this auction data, making it easier to identify high-probability trade setups. Organizing the day. Every trading day has a unique structure, but it also follows predictable patterns. The market opens, participants react to overnight developments, price moves in search of value, and the session eventually settles. Market Profile helps traders organize the trading day into meaningful phases. 1. The opening auction sets the initial direction and tone. 2. Morning range formation establishes key reference levels. 3. Midday consolidation, often a period of low activity as traders wait for new information. 4. Afternoon move, a second wave of momentum often emerges. 5. Closing auction, institutions adjust positions before the session ends. Recognizing these phases improves timing and execution, allowing traders to align with the market's natural flow instead of reacting emotionally. Challenging the rules. Most traders enter the market with a rigid mindset. They follow traditional rules and expect the market to behave in a certain way. But markets aren't static. They evolve, adapt, and often break conventional expectations. Common trading myths that need to be challenged. Always buy low, sell high. The market doesn't care about absolute highs or lows. It responds to supply and demand imbalances. Support and resistance are fixed levels. Price can slice through these areas if conditions change. Indicators predict the market. They only reflect past data, not future movement. Successful traders observe what's happening in real time rather than forcing the market to fit preconceived notions. The role of the marketplace. The market is more than just a place to buy and sell. It's a battleground of competing interests. Institutional traders, hedge funds, retail traders, each has different objectives and time horizons. Understanding who is in control at any given moment is critical. Short-term traders respond to immediate price movements. Longer-term participants focus on value and trends. Market makers provide liquidity but can also influence price action. Market Profile helps identify which group is driving the market, allowing traders to align their strategies accordingly. Going with the crowd. Most traders assume following the crowd is a mistake, but crowd behavior is not inherently wrong. It's how trends are created. The key is knowing when to follow and when to step aside. In balanced markets, price rotates within a range, and going against the crowd often works. In trending markets, momentum builds as more participants jump in, and fighting the trend can be costly. Market Profile provides a clear picture of crowd behavior, showing where traders are most active and where the market is likely to move next. Day time frame structure. Every trading day has a unique rhythm, but it follows certain patterns that repeat over time. Understanding these patterns is crucial because they help traders anticipate price movements, manage risk, and align with market dynamics instead of reacting emotionally. Market Profile organizes the day into distinct structures based on price action and trader behavior. These structures reveal who is in control, buyers or sellers, how strong their presence is, and what kind of trading opportunities exist. Let's break down the key types of market days and what they mean for traders. Normal day. A normal day is like a steady, controlled auction where price establishes a fair value early and doesn't stray far from it. The defining characteristic? A wide initial balance, the range set in the first hour of trading, followed by limited range extension. Early balance is set by strong institutional traders. The rest of the day sees minor movement away from that range. Volume is evenly distributed, and no extreme directional moves occur. This type of day usually happens when new information is limited and the market is digesting previous moves. It's common after major trend days or news-driven events. For traders, a normal day suggests a range-bound environment where scalping and mean reversion strategies work best. Breakout trades are low-probability setups on these days. Normal variation of a normal day. A normal variation day starts like a normal day, but has a slight twist, a moderate range extension beyond the initial balance. The first hour sets the tone, just like a normal day. One side gains control later in the session, leading to a directional push. The move isn't extreme, but is significant enough to create a tradable opportunity. This structure often forms when new information emerges midday, prompting traders to adjust their positions. Trend-following strategies can work once the range extension is confirmed. Trend day is driven by aggressive institutional participation, causing price to move steadily in one direction. The key traits? A narrow initial balance and consistent directional movement throughout the session. One side dominates the market from the start. Pullbacks are shallow, and price does not return to previous levels. Volume builds as the trend progresses, confirming participation. Trend days often start with a major news event or a shift in market sentiment. Traders who try to fade the move, betting on reversals, get trapped, fueling further momentum. For traders, the best approach is to align with the trend early and ride the move. Reversal setups are low probability, and trying to pick tops or bottoms can be dangerous. Double distribution trend day. A double distribution trend day starts with balance, but then transitions into a strong trend. The day is divided into two clear distributions, one in the early session and another in the later session. The market begins with a balanced structure like a normal day. At some point, a breakout occurs and price moves aggressively in one direction. Once the breakout is established, price forms a new distribution at a higher or lower level. This type of day often traps traders who assume the initial balance will hold. By the time they realize a trend is forming, the market has already made a significant move. For traders, the key is to recognize the shift from balance to trend. When price leaves the initial distribution, look for entry opportunities in the new developing range. Non-trend day. A non-trend day is marked by low volatility and a narrow range. Neither buyers nor sellers are aggressive, and price remains within a tight consolidation zone. The initial balance is wide, meaning both sides are active but indecisive. Volume is low, and price does not extend far from the opening range. There is no strong directional conviction from market participants. Non-trend days often occur before major economic releases or during holiday sessions when institutional participation is low. For traders, this environment is best for scalping short-range moves. Breakout strategies have a low success rate as price lacks momentum to sustain a move. Neutral day. A neutral day is when price moves in both directions but fails to sustain a trend. Both buyers and sellers test the market, but neither gains full control. The initial balance is moderate, allowing for range expansion. Price moves above and below the opening range, but eventually closes near the middle. Both long and short positions get tested throughout the session. This type of day indicates indecision and balance between buyers and sellers. It often appears before major trend reversals or when the market is digesting conflicting information. For traders, neutral days are best approached with patience. Trading breakouts is risky since price tends to mean revert. Instead, looking for trades near support and resistance within the day's range can be more effective. Advanced beginner. Stepping beyond the basics, a trader starts to see the market not just as a series of price movements, but as a structured environment driven by logic, time, and participation. The goal at this stage is to move from simply observing price action to understanding the bigger picture, why the market moves the way it does, who is participating, and how to position trades based on this deeper insight. This transition requires a structured approach that integrates market logic with real-time decision-making. Let's break down the core elements that help in building this framework. Building the framework. Most traders, when starting out, focus on entries and exits, where to buy and where to sell. But true skill comes from understanding why price is moving and what the market is trying to accomplish. This is where market profile provides an edge. Instead of just looking at price, traders begin to analyze who is in control, buyers or sellers, where is the market finding value, what timeframes are influencing today's session. Building this framework helps traders shift from chasing price to anticipating movement based on market-generated information. The big picture: market structure, trading logic, and time. The market is not random. It operates within a defined structure, influenced by logic and time. 1. Market structure. The market forms identifiable patterns that repeat across different timeframes. These structures help traders understand whether the market is balanced or imbalanced, if a breakout has real strength or is likely to fail, where high probability trade locations exist. 2. Trading logic. Every price movement is a result of buying and selling pressure. Market profile helps traders see the logic behind these movements. Strong trends develop when one side overpowers the other. Ranges form when buyers and sellers agree on fair value. Fake breakouts happen when one side lacks conviction. 3. Time. Time is a crucial factor in evaluating market strength. A strong move should sustain momentum over time, while a weak move will fail quickly. Observing how price interacts with time gives traders an edge in identifying true breakouts versus failed attempts. Recognizing when a move is losing momentum, understanding which price levels hold real significance. Bringing together structure, logic, and time allows traders to step back from the noise and trade with clarity and confidence. A synthesis: structure, time, and logic. At this stage, trading stops being about memorizing patterns and starts becoming an intuitive process based on market understanding. By combining market structure, where price is likely to move, trading logic, why it's moving there, and time analysis, how long the move sustains, traders start making decisions based on real market conditions, not just theoretical setups. Instead of blindly following signals, traders ask, is the market balanced or trending? Which timeframe participants are in control? How does today's price action fit into the bigger picture? This synthesis sharpens decision-making and helps traders avoid emotional reactions to price movements. Ease of learning. At first, this approach may seem complex, but in reality, it simplifies trading by removing unnecessary noise. Instead of juggling dozens of indicators, traders focus on what truly matters: price, volume, and time. Many beginners struggle because they overload themselves with information, jumping from one strategy to another, chasing signals without understanding the underlying market dynamics. But by focusing on the core principles of market profile, traders gain a structured and repeatable process that works in all market conditions. Amount of information. A major challenge for developing traders is handling too much information at once. The market provides endless data, news, indicators, economic reports, but not all of it is relevant. The key is filtering out the noise and focusing on actionable information. Market profile helps traders identify key price levels instead of following every tick, understand market intent instead of reacting emotionally, trade with conviction instead of second-guessing every move. By learning to organize information effectively, traders build a streamlined decision-making process that allows them to trade confidently without being overwhelmed. Recognition speed. In trading, speed matters. The market moves quickly, and the ability to recognize what's happening in real time separates experienced traders from those who are always a step behind. Recognition speed is all about how fast you can identify market conditions, patterns, and opportunities. The faster you recognize a shift in market behavior, the better positioned you are to act decisively. A slow trader hesitates, misses entries, and gets caught in bad trades. A sharp trader reads the market, anticipates movement, and reacts with confidence. So how do you improve recognition speed? 1. Develop market awareness. Train yourself to see the structure forming in real time instead of waiting for confirmation that's already too late. 2. Focus on key levels. Instead of watching every tick, track important price zones where market participants are likely to act. 3. Reduce distractions. Too many indicators slow you down. Stick to what matters: price, volume, and time. Recognition speed isn't about predicting the future. It's about being so familiar with market behavior that you instantly know when something changes. Trade location. Even the best analysis is useless if your trade location is poor. Where you enter a trade matters just as much as why you enter it. Market profile teaches traders to identify areas of value where risk is low and reward is high. These areas typically include high volume nodes, HVN, price levels where the market has spent significant time, indicating strong support or resistance. Low volume nodes, LVN, areas where price moves quickly, often acting as breakout or reversal zones. Previous day's high, low, and point of control, key reference points where buyers and sellers have previously battled. A trader with good trade location enters near value and avoids chasing price. Keeps risk tight because price is unlikely to move against them immediately. Has a strong risk-reward ratio, increasing long-term profitability. Many traders lose money not because their analysis is wrong, but because their entries are poorly timed. Learning how to identify the right trade location is what turns a struggling trader into a profitable one. Confidence level. Every trade is a decision, and decisions require confidence. But confidence in trading doesn't come from ego. It comes from experience and preparation. Confidence is built through pattern recognition. The more you see certain market behaviors play out, the more trust you develop in them. Risk management. Knowing that even if a trade fails, you're protected, removes fear from the equation. Executing without hesitation. Second guessing leads to missed trades. Confident traders take action based on their plan, not emotions. Confidence doesn't mean taking unnecessary risks. It means trusting the process, managing risk properly, and executing trades with conviction. A trader with confidence stays in winning trades longer and cuts losing trades quickly, while a trader lacking confidence hesitates, doubts, and makes emotional decisions. Competent trader, understanding other time frame control. At this stage, a trader is no longer reacting blindly to price movements. Instead, they recognize that the market is shaped by different types of participants operating across various timeframes. Understanding how these players influence price action is critical for making informed trading decisions. One of the biggest mistakes traders make is assuming that every price move is random. But when you break it down, the market is constantly balancing and rebalancing based on the actions of short-term traders, day traders, and long-term investors. So how do you evaluate who is in control at any given time? Evaluating other time frame control. The market isn't moved solely by day traders. Bigger players such as institutions and hedge funds have a major influence on price action. These other time frame participants enter the market with larger capital and longer-term objectives, which means their presence can dictate market direction and structure. Recognizing when these players are active helps traders avoid fighting the dominant force. If long-term buyers are stepping in, short-term sellers will struggle to push the market lower. If institutions are unloading large positions, the market will keep dropping regardless of short-term buying. The key is to watch for volume spikes at key price levels, sharp, aggressive moves with follow-through, sustained trends that don't easily reverse. When you identify these signs, you gain an edge by aligning yourself with a stronger force instead of trading against it. Other time frame control on the extremes. Extremes, either session highs and lows or major support and resistance zones, are areas where other time frame traders often step in aggressively. Why? Because long-term traders don't chase price in the middle of a range. They wait for price to reach extreme levels before making a move. When price reaches an extreme and reverses sharply, it signals that larger players are stepping in. If price breaks through an extreme and continues trending, it suggests strong momentum from higher time frame participants. Knowing this, traders can make smarter trade entries by looking for confirmation at these extremes. If there's strong rejection, it's a signal to trade in the opposite direction. If there's acceptance, it means the move has strength. Tails, or extremes. A tail in market profile is formed when price moves sharply in one direction, but quickly gets rejected, leaving behind a long wick on the chart. This tail represents an area where the market tested a price level but failed to sustain movement. Tails occur when buyers step in aggressively at a low, creating a long lower tail. Sellers push price down after a rally, forming a long upper tail. These extremes act as high probability trade locations because they show where strong opposing forces exist. If you see a well-defined tail, it's often a sign that price is unlikely to return to that level immediately. Range extension. The market doesn't stay in a tight range forever. At some point, one side will overpower the other, leading to a breakout and range extension. Range extension is significant because it tells you which side is gaining control. If price extends beyond the initial balance to the upside, buyers are stronger. If price breaks below the initial range, sellers are in control. The key here is to watch for volume. A breakout with strong volume confirms participation from other timeframe traders, making it more likely to sustain. A breakout on low volume is often a trap. Other timeframe control in the body of the profile. While extremes are important, other timeframe traders also influence the middle of the profile. These participants aren't always waiting for extremes. They step in when they see value. This happens when price consolidates within a high-volume area, signifying that both buyers and sellers are active. Sharp rejections occur inside the range, indicating that larger players are defending their positions. By identifying where these participants are active, traders can better predict whether a breakout will hold or if the market is simply balancing. TPO, Time Price Opportunity. TPO stands for Time Price Opportunity, a key concept in market profile that measures how much time price spends at certain levels. The more time price spends at a level, the more accepted it becomes. Areas with a high number of TPOs are considered value areas, while areas with few TPOs are low volume zones that price moves through quickly. Understanding TPO structure helps traders identify where the market sees value, find high probability trade locations, avoid getting caught in low volume traps. Proficient trader, mastering the core elements of trading. Reaching the proficient level in trading isn't about knowing more, it's about executing better. At this stage, traders move beyond theory and into precision, consistency, and discipline. They understand that success in the market comes down to capital, location, timing, information, competition, self-awareness, and daily execution. Let's break these down one by one. Capital. The lifeline of your trading career. Capital isn't just money, it's your ability to stay in the game. Many traders focus on making profits, but the real key is protecting your capital so you can trade another day. Risk small, survive longer. The best traders don't swing for home runs. They manage risk and think long term. Never risk more than you can handle. If one bad trade can wipe out your account, you're trading too big. Preserve capital in choppy markets. When conditions aren't clear, step back. Protecting your funds is just as important as making money. Without capital, you can't trade. Survival comes first. Growth comes later. Location, enter where the market gives you an edge. A trade is only as good as its entry point. Proficient traders wait for the market to come to them instead of chasing price. Trade at logical levels. Identify high probability areas where price has shown strong reactions in the past. Don't chase moves. If you're entering late, you're taking unnecessary risk. Look for confirmation, not hope. A good location is backed by market structure, not emotion. Great entries mean less risk, better reward, and higher confidence in every trade. Timing. Right idea, wrong time, wrong trade. A good trade executed at the wrong time is just as bad as a bad trade. Timing matters. Early entries, getting stopped out prematurely. Late entries equals chasing and reducing profit potential. Perfect timing, high reward with minimal risk. To master timing, watch for confirmation before pulling the trigger. Understand market rhythms. Some times of the day are more favorable for execution than others. Be patient. Let the trade come to you instead of forcing it. Information. The edge comes from what you know. The market is a constant flow of information. Proficient traders know how to filter noise and focus on what matters. Market profile and order flow. These tools provide insights into where traders are positioned. Volume and price action. Watch where big money is moving, not just price alone. Sentiment and news awareness. Fundamental factors can impact market psychology, but they should support, not dictate, trading decisions. Successful traders don't just react to price, they understand the context behind the move. Know your competition. Who's on the other side? Every trade has a buyer and a seller. If you don't know who's on the other side, you are the liquidity for a more informed trader. Are you trading against short-term retail traders? If so, expect more volatility and randomness. Are institutions entering the market? Their orders move price in a sustained way. Are traders trapped in the wrong direction? If so, expect sharp reversals. Understanding who you're trading against helps you avoid unnecessary risks and capitalize on predictable behavior. Know yourself. Mastering your own psychology. A proficient trader isn't just skilled in market mechanics. They are deeply aware of their own strengths and weaknesses. Do you struggle with impulsive trades? Build discipline through structured rules. Do you get fearful in drawdowns? Reduce your risk until you trade with confidence. Do you hesitate on good setups? Work on trusting your preparation. Your mindset is just as important as your strategy. The biggest edge in trading is self-awareness. Consistent daily execution, the real key to mastery. The difference between a good trader and a great trader is consistency. The best traders don't get caught up in individual wins or losses. They focus on executing their edge every single day. Stick to your process. Follow your plan, not emotions. Review your trades. Learn from mistakes and improve. Stay disciplined. The market rewards those who show up prepared day after day. The goal is not perfection. It's consistency in applying what works. Becoming a professional trader, mastering inventory, risk, goals, and execution. At this stage, trading isn't just about spotting opportunities. It's about managing yourself, your risk, and your performance like a professional. Traders who reach this level think strategically, track their progress, and refine their approach daily. Let's break it down. Inventory, understanding market positioning. Just like a business manages its stock, professional traders track inventory in the market. This means understanding. Who is holding positions? Are traders heavily long or short? Where are traders trapped? If too many traders are positioned one way, the market often moves against them. What is the balance of supply and demand? If buyers are aggressive, but price isn't moving up, sellers are absorbing those orders. By analyzing market inventory, traders can spot areas where a big shift is likely to happen. This is where high-probability trades emerge. Key takeaway: the market is constantly adjusting its inventory. Your job is to recognize when it's imbalanced and take advantage. Risk, the most important part of trading. Every great trader understands that trading is a game of survival. Profits come to those who manage risk first. Here's how professionals handle risk. Define risk before entering. Know your stop loss before you place a trade. Never risk more than you can afford to lose. Keep losses small so they don't impact your ability to trade tomorrow. Adjust position size based on market conditions. Bigger trades in high probability setups, smaller trades in uncertain conditions. Cut losses fast, let winners run. The best traders are great at exiting bad trades quickly and holding on to good ones. Risk isn't about avoiding losses, it's about controlling them so they don't wipe you out. Key takeaway: if you master risk, you stay in the game. If you ignore risk, the game ends quickly. Goals: setting clear targets for success. A trader without goals is like a ship without a compass. You need clear objectives to measure progress and stay focused. Professional traders set goals in 3 key areas. Process goals. Focus on following your trading plan, not just making money. Performance goals. Improve execution, timing, and discipline. Growth goals. Expand your skills by learning new strategies and refining your edge. The best goals are specific, measurable, and realistic. Instead of saying, I want to make more money, a better goal would be, I will stick to my risk management rules on every trade this week. I will take only A-plus setups and avoid emotional trades. Key takeaway: focus on small, consistent improvements. Over time, they compound into massive success. Record keeping and performance: the secret to long-term improvement. A trader who doesn't track performance is flying blind. The best traders analyze their trades, identify mistakes, and improve continuously. What should you track? Entry and exit points. Were they optimal, or did emotions affect your decision? Market conditions. Was the market trending or ranging? Did you adapt accordingly? Psychology. Were you patient, or did fear and greed influence your trade? Mistakes and lessons. Every loss is a learning opportunity. What can you do better next time? By keeping detailed records, traders can spot patterns in their behavior and refine their strategy. Key takeaway: improvement comes from self-analysis. If you don't track your trades, you're missing out on valuable insights. Dedication: the difference between amateurs and professionals. Trading isn't a hobby. It's a lifetime commitment to learning, adapting, and refining skills. The market is always evolving, and the best traders evolve with it. Dedication means showing up every day, even when results aren't great. Studying the market outside of trading hours, constantly refining and improving your edge. Most people quit when they face setbacks. Professionals embrace the struggle, learn from it, and keep pushing forward. Key takeaway: success in trading isn't about luck. It's about relentless dedication to improvement. Applications: putting it all together in the real market. All the knowledge in the world is useless unless it's applied. The final step is execution, putting your skills into practice with confidence and discipline. Here's how professionals approach the market daily. Start with a clear plan. Identify key levels, market structure, and high probability setups. Wait for confirmation. Let the market prove your trade idea before committing. Execute without hesitation. Once conditions align, enter the trade with full confidence. Review and adapt. At the end of the day, analyze what worked and what didn't. Key takeaway: the market rewards those who execute consistently, refine their approach, and learn from every trade. The expert trader, mastering the market with experience, psychology, and discipline. At this level, trading is no longer just about strategies. It's about deep market understanding, self-awareness, and disciplined execution. The best traders don't just react to price. They anticipate market movement based on experience and psychology. Let's break it down. Experience, the foundation of mastery. There's no shortcut to becoming an expert trader. Real expertise comes from experience. Unlike beginners who rely on rigid rules, expert traders develop intuition by deeply understanding market structure, order flow, and trader psychology. Here's what experience teaches: how to adapt when the market shifts, when to be aggressive and when to stay out, how to trust instincts developed through thousands of observations. Experience isn't just about screen time. It's about learning the right lessons from the market and applying them consistently. Key takeaway: true expertise is built over time through focused observation and continuous improvement. Set aside your expectations. Trading without bias. One of the biggest mistakes traders make is trading with expectations instead of responding to reality. When traders become attached to predictions, they ignore what the market is actually telling them. The expert mindset is different. No attachment to outcomes. Every trade is just one of many. No emotional reaction to wins or losses. It's all part of the process. No forcing trades. If the market isn't offering opportunities, patience is key. By letting go of expectations, expert traders free themselves to react to what's happening instead of what they think should happen. Key takeaway: the market doesn't care about your opinion. Trade what's in front of you, not what you wish would happen. Mind over markets in profile, seeing the bigger picture. At the highest level, traders stop focusing on individual price movements and start seeing market structure as a whole. Instead of getting lost in short-term noise, they recognize how all the pieces fit together. This includes understanding the auction process and how prices seek balance, identifying who is in control, short-term traders or long-term players, recognizing when price is being accepted or rejected. Instead of chasing trades, expert traders position themselves where opportunity naturally develops. Key takeaway: see the market as a dynamic system, not just price bars on a screen. Market understanding and self-understanding, the two sides of success. The market is a reflection of human psychology, but so are you. To master trading, you must master both market understanding and self-understanding. This means recognizing when emotions influence your decisions, knowing your strengths and weaknesses as a trader, understanding your personal risk tolerance and adapting accordingly. A great trader isn't just analyzing the market, they're also analyzing themselves and making adjustments when needed. Key takeaway: the best traders don't just study the market, they study themselves. Perfect practice makes perfect. Training like a professional. The way you practice determines the results you get. Random, unfocused practice leads to random, unfocused results. Here's how expert traders practice effectively. Deliberate focus. They review past trades, identifying strengths and weaknesses. Simulation and replay. They replay market sessions to sharpen instincts. Journaling and reflection. They track what's working and refine their approach. Instead of just trading for the sake of it, experts train with intention, treating each session as an opportunity to improve. Key takeaway: trading success isn't about talent, it's about disciplined, structured practice. Blinded by price, looking beyond the obvious. Amateur traders focus only on price, thinking that movement alone tells the full story. But expert traders know that price is just one part of the equation. They look deeper by analyzing market profile and structure. Where is price being accepted or rejected? Volume and participation. Are buyers and sellers truly committed? Market context. Is price action part of a larger trend or just short-term noise? Instead of reacting to price alone, expert traders focus on the underlying mechanics that drive price movement. Key takeaway: price is just the surface. Look deeper to understand what's really happening. Be prepared, the professional approach to trading. Success in trading is about preparation. The best traders don't just show up and react. They plan, analyze, and execute with confidence. Being prepared means having a clear game plan before the market opens, knowing key levels, trade scenarios, and risk management rules, reviewing performance after every session and making adjustments. The difference between an amateur and an expert: the expert is always ready. Key takeaway: if you're not prepared, you're already behind. Mastering market perspective, understanding inventory, gaps, and statistical thinking. Trading isn't just about placing orders, it's about seeing the market from the right perspective. When you understand how inventory shifts overnight, why gaps can be opportunities, and how statistical thinking plays a role, you gain an edge over the competition. Let's break it down. Perspective: seeing the market clearly. A professional trader doesn't just look at price, they see the entire market in context. Perspective means understanding. Who is in control, buyers or sellers? Where price is being accepted or rejected? How today's market fits into the bigger picture. Instead of reacting to every small move, the best traders focus on what actually matters. They filter out noise and focus on the larger forces driving the market. Key takeaway: a good trader watches price. A great trader understands the bigger picture. Overnight inventory. Who's trapped? Markets don't just reset every morning. What happens overnight sets the stage for the next trading session. Here's why overnight inventory matters. Who is holding positions overnight? Are they in profit or are they trapped? Will the market continue in the same direction or reverse? A trader who ignores overnight activity is trading blind. Understanding overnight inventory helps anticipate who will be forced to act when the market opens. For example, if traders piled into long positions overnight but price opens lower, they're trapped. A sell-off may follow. If overnight traders were short and price gaps up, they'll rush to cover, pushing prices even higher. Key takeaway: the market opens with built-in pressure from overnight traders. Use it to your advantage. Gaps can be gold, turning market openings into opportunity. A gap is one of the most important signals at market open. It tells you whether price is breaking out of a previous balance, overreacting and likely to reverse, confirming or rejecting overnight positioning. How do expert traders approach gaps? Gaps that hold. If a gap doesn't fill quickly, it often signals strength in that direction. Gaps that fill immediately. If price rushes back into the previous range, the move was likely an overreaction. Large gaps, big overnight moves often mean institutions are involved, setting the trend for the day. Gaps aren't random. They're the market's way of revealing imbalance. When you read them correctly, they can be gold. Key takeaway. Gaps tell you where the real battle is happening. Learn to read them. Gaining an edge, thinking like a pro. Every trader wants an edge, but most search in the wrong places. The best edge doesn't come from secret indicators. It comes from understanding the market better than others. Here's where real edge comes from. Knowing how different players, institutions, retail algorithms interact. Recognizing when the market is balanced or out of balance. Reading the flow of inventory and positioning. Instead of relying on gut feelings, expert traders use logic, structure, and data to gain an edge. They don't trade every move. They trade only when they see clear opportunities. Key takeaway. Edge isn't magic. It's about knowing the game better than the competition. The fairest price revealed. Understanding market value. Not all prices are equal. The market has a natural price where buyers and sellers agree. This is called the fairest price. You can spot it by looking at the point of control, C, on the market profile. Identifying where the most volume has traded. Watching how price reacts when it reaches these levels. When price moves far away from its fairest value, it often snaps back unless a new trend is forming. Traders who recognize these value levels can anticipate reversals and continuation moves. Key takeaway. If you know where value is, you know where price wants to go. Thinking statistically, playing the probabilities. Expert traders don't rely on hope, they rely on probabilities. They don't expect to win every trade. They expect to be profitable over time. They measure their edge with data. They know their win rate and average reward to risk. They trade based on probabilities, not emotions. For example, if a setup has a 60% chance of success and offers 3x the reward versus his risk, they take the trade without hesitation. Because over 100 trades, it's a winning strategy. Thinking statistically means letting go of individual trade results. One loss doesn't matter in the long run. Focusing on execution, not emotions. You can't control outcomes, only your process. Understanding risk and reward on every trade, never risking too much on a single idea. Key takeaway. Successful traders think like casinos, always playing the probabilities in their favor. The most important omission from the first printing in 1990. When Mind Over Markets was first published, one crucial aspect was overlooked: the emotional and psychological challenges of trading. While the book focused on market profile and market structure, it didn't fully address how traders' emotions impact decision-making. This omission highlights how self-awareness and emotional control are just as critical as technical skills. Emotional markets. Markets are not just numbers and charts. They are driven by human emotions: fear, greed, uncertainty, and overconfidence. Emotional trading leads to impulsive decisions, chasing moves, and panic selling. The best traders recognize when emotions are dominating the market and adjust their strategies accordingly. A landscape view of the market. Instead of focusing on minute-by-minute fluctuations, successful traders take a broader perspective. Understanding the overall market structure, larger trends, and the context of price movements helps traders avoid getting caught in short-term noise. This approach shifts the focus from reacting to anticipating market behavior. Personal evolution. Every trader undergoes a personal transformation. Early on, they rely on patterns and indicators, but over time, they develop intuition, confidence, and adaptability. The best traders evolve from being reactive to proactive, focusing on execution rather than emotions. This evolution is the difference between struggling traders and those who succeed consistently. Hierarchy of information. Not all market information is equally important. Traders must learn to filter out noise and focus on the data that truly drives price action. This hierarchy includes 1. Market-generated information, price, volume, market profile. 2. Context, trend direction, balance areas, breakouts. 3. External factors, news, economic reports, sentiment. Time frame control, who is dominating the current session? Markets operate on multiple time frames. Short-term traders, swing traders, and long-term investors all influence price movement. Identifying which group is in control helps traders align their strategies with the dominant force rather than fighting against it. Markets are visual. Trading is not just about numbers. It's about recognizing patterns, structure, and market psychology visually. Market profile provides a clear way to see where buyers and sellers are active, making it easier to spot opportunities and risks. Markets move towards specific targets, key support and resistance levels, previous highs and lows, and areas of high volume. Understanding these destination points helps traders anticipate where price is likely to go next instead of reacting to every small fluctuation. The opening. The market open sets the tone for the entire trading day. Watching how price behaves in the first 30 minutes can reveal whether the market will trend, balance, or reverse. Professional traders pay close attention to the opening range, volume, and how price reacts to overnight positioning. Trends. Understanding trends is crucial, whether the market is in a strong directional move, a slow grind, or a choppy range. Recognizing trend strength, exhaustion points, and when trends shift gives traders a significant edge. Instead of predicting, great traders react to what the market is telling them. And that's a wrap on today's breakdown of Mind Over Markets. I hope you found these insights helpful and are feeling more confident in applying market profile and trading psychology to your own strategies. Remember, mastering the market takes time, but with the right mindset and tools, you can stay ahead of the game. If you enjoyed this video and want more trading tips, don't forget to like, share, and subscribe. Hit that bell icon so you get notified every time we drop new content to level up your trading skills. Drop a comment below and let me know what part of the book you found most valuable, or if there's another trading topic you'd like us to dive into next. Thanks for watching, and I'll see you in the next one.